In the last 10 days, a major cryptocurrency bank has failed, another has been taken over by the federal government, and most shockingly, a top 20 largest bank has also collapsed. In this video, I'm going to explain step by step in simple terms how this happened and what it means for your money. By the end, you'll know everything that you need to know about the 2023 banking collapse. What's up everyone? My name is Derek and I got my degree in finance, so you don't have to. Let's break down what has happened in the last 10 days and what it means for your money. Now, 3 banks have failed. In order to understand this, we need to know one word and 2 major keys. That one word is bonds. This entire mess stems directly from bonds, federally backed bonds to be precise. This will be very important later. Now, the 2 major keys. We need to understand that interest rates and bonds move in opposite directions. This is known as inverse correlation. This means that when interest rates rise, bond prices come down. Simply put, this is because bonds pay out a fixed amount. But when interest rates rise, the new bonds pay out a higher rate of return. This means that the percentage returned on bonds already issued must rise as well. The only way for this to happen without changing the payout amount is for the bond price to come down. So the first thing that we need to understand is that bonds and interest rates are inversely correlated. The second major point that we need to understand is that Silicon Valley Bank, Silvergate, and every other major bank invests heavily in federally backed bonds. This is because federal bonds are among the safest investments out there if they are held to the bond's maturity. The bond's maturity is the date that the bond is due back in full. This will also be very important later on. Okay, so what happened? Let's start with Silicon Valley Bank. It is the second largest bank to ever fail. This makes the collapse a major event. Now, what went wrong? Silicon Valley Bank was a major bank in the tech world, hence the name, and at its peak, it claimed to bank almost half the startup tech companies in the United States. This impressive feat that it touted as a positive and most certainly used as a symbol of strength to new potential customers ended up being its downfall. The reason you probably haven't heard of this bank until now is because the majority of its clientele were tech startups, tech companies, venture capital firms, and medical companies. This, my friends, is what is known as the opposite of diversification, and diversification, we know, is key to a strong financial future. Now let's rewind to the years leading up to 2022. Interest rates were low, which means the venture capital business was booming, and so was tech. Money was virtually free, and venture capital firms had no better place to park their money than in tech. This is because other options like bonds were at the time returning so little. This was excellent for tech companies. Easy money, fast-paced growth. Now, where did tech companies deposit all this juicy money? With Silicon Valley Bank, of course. And then the perfect storm began. And this perfect storm starts with everyone's least favorite year, 2020. We all know what happened in 2020, and the government responded. Money was printed in insane amounts. A necessary evil, they said, to keep food on the tables and businesses alive. But what happens when you print and print and print money? Money supply rises, and so do prices of everything. This is called inflation, and inflation was the seed that planted the tree that inevitably doomed Silicon Valley Bank. Now let's fast forward a little bit to the end of 2021. Inflation is out of control and the Federal Reserve knows it. But the Federal Reserve seems to be a one-trick pony when it comes to combating inflation. And it used that one trick again by raising interest rates a lot and very fast. This turned the perfect storm that was brewing inside the banking sector into the perfect hurricane, and SBV was about to feel the full force of that storm. Now let's remember that SBV was heavily invested in US-backed bonds. And let's remember that when interest rates rise, bond prices fall. Now, this usually isn't a problem, especially if you're planning to hold the bond until maturity, but it becomes a major problem when almost all of your clientele are tech firms, because interest rates also caused major problems in the tech industry. Higher interest rates meant that venture capital firms had another juicy place to park their money: bonds. Bonds were returning more. This means that they were less eager to lend to risky tech companies and startups. Unfortunately, for tech companies and eventually Silicon Valley Bank, the cash burn rate does not care if you can find funding or not. Bills still need to be paid, as well as payroll, expenses, advertising, and office leases. So tech, needing to pay its bills but with less VC funding, turned to its coffers. And where were they? Most of them were, of course, in SBV. But we know SBV had most of its client money locked in federally backed bonds. And they were worth a lot less now than they were a few years ago. This is what's called a paper loss, but it was about to become a very real loss when tech companies started withdrawing money at a much larger rate than usual. With a lot of its money locked up in bonds, SBV did not have the capital on hand to process those withdrawals. So what was it forced to do? It was forced to start selling its bond portfolio at a loss. This is obviously unsustainable, so it searched for funding, and it almost pulled it off. It was going to raise cash to cover its $1.8 billion paper loss by selling stock. Unfortunately for SBV, word got out, people panicked, and their stock crashed over 50% basically overnight. And another much worse thing happened, a bank run. The already unsustainable withdrawal rate shot through the roof when more than $40 billion were queued for withdrawal. That, my friends, was the final nail in the coffin, and Silicon Valley Bank collapsed. Being the second largest bank to ever collapse, this is catastrophic. But SVB was not alone. In fact, 2 other banks have also collapsed, all 3 in the span of less than 2 weeks. Enter Silvergate Bank. A bank originally created for real estate turned into a crypto banking superpower. With the rise of cryptocurrency also came the rise of Silvergate Bank and its deposits. But with the fall of cryptocurrency also came the fall of Silvergate Bank. This is another story of lack of diversification and a reliance on bonds going very, very badly. It's honestly almost as if Silvergate and SBV copied each other's homework. For Silvergate, it all started with the cryptocurrency crash, and then the FTX bankruptcy, followed by the Gemini Earn debacle. While these 3 events may or may not have affected Silvergate directly, it did scare cryptocurrency users, and it scared them enough for people to want to start withdrawing their funds at a higher than usual rate. Honestly, let's call it what it was, a bank run. And again, bonds struck like bombs because Silvergate was heavily invested in mostly long-term US-backed bonds. And the fatality? Over 80% of Silvergate's deposits came from the crypto sector. So the bank that people ran to was Silvergate. And just like Silicon Valley Bank, Silvergate could not fulfill withdrawals and it collapsed. I wish I could say this was the end, but it is not. A 3rd bank has just been taken over by US regulators. That bank's name is Signature Bank. It's a bad day to be a bank that starts with the letter S, I guess. And this bank suffered almost the exact same fate as Silvergate. Everyone is copying everyone's homework, I guess. Crypto heavy, bank run, bust. So the most important question, what does this all mean for your money? Well, it depends. Where do you bank? And is your bank well diversified? But even if it is, this technically can happen at any bank at any time. And that is because a bank run is basically a self-fulfilling prophecy. People lose faith in the bank and they run to withdraw their money. And because banks are not required to hold a $1 for everyone's deposit, a collapse is theoretically possible at any bank, no matter how small or how large. But there is good news. Let's call it a silver lining to all of this. 1. FDIC insures every deposit up to $250,000, one account per bank. 2. Larger banks, where most people hold most of their money, have stricter regulations on how much cash they have to hold in easily accessible assets to cover withdrawals. And 3. Most larger banks are well diversified, storing their deposits in cash, bonds, mortgages, car loans, leases, credit cards, lines of credit, and many other investments. But what if there was a major scale bank run on a major US bank? Well, no need to worry, right? Because FDIC insurance would step in to cover your deposits. But I guess that's only comforting if you truly trust the US government to fulfill its responsibility.